So good morning, everybody. My name is Mary Copeland. I am the owner and founder of Compass and Clock, this wonderful, informative publication that we publish twice a year. It's also available online. And in addition to the magazine, we have lots of other multimedia means in which to provide information to you, such as today. Today, you are joining us for our first Compass Points. This will be the third Thursday of each month at 11:30 a.m. till 12:30 p.m. So consider it a lunch and learn. We will have a panel of experts that will be providing you with current information that can help you right now in your life and also into your future. So with that said, I am going to introduce our first guest, which is Walt Schultz. He is the owner of Schultz Associates CPAs. I personally use him for our taxes and also mine and my husband's business taxes. And Walt, after you, when it's Matt's turn, Matt, then you'll introduce yourself and tell everybody what you do, and the same for you, Tony. So Walt, the floor is yours. Please take it away.
Thank you, Mary. So I just did a screen share. Can you guys see my screen at this point? Okay, good. I actually practiced with this morning to make sure I could figure out how to do this. So what I want to talk about today is tax preparation during a pandemic and try to hit on some of the highlights of a bunch of tax laws that have changed this year. And there's a lot of detail and a lot of material, and that we have a fairly short window of time here. So some of this I'm just going to kind of breeze through and hit some high points. But I think I've got the main issues on here that are probably of the most interest to people. So the first thing I wanted to comment is that, you know, we're in the midst of a pandemic and everybody's trying to figure out the new way to do business. And in the midst of all that, we've got a whole bunch of tax law that has changed in recent history. And this list is not all of the tax bills that have happened, but it's kind of the high points of what happened. You know, back at the end of 2017, we had the Tax Cut and Jobs Act that most of the provisions in that took effect the January 1st of 2018. And that was probably the largest tax overhaul that we've had in 30 years or so. And, you know, we're now a couple of years into that, and people are still learning that they can't itemize deductions anymore, that they have to use the standard deduction and so forth. So it's a evolution process. But then what has happened in the last year is we have kind of three other big things that happened. We had the CARES Act, of course, which was the result of the coronavirus crisis, and most of the provisions of the CARES Act that impacted taxes are generally effective as of the beginning of 2020. Now, there are some things in all of these bills that end up being retroactive and can go into older years, but they're the exceptions, not the rule. Most of these changes are for 2020 and beyond. We also had an act called the Setting Every Community Up for Retirement Enhancement Act, which is known as the Secure Act, and that changed some of the rules related to retirement plans, which we're going to talk about in a little bit of detail here. And then most recently, right at the end of the year, we had the Consolidated Appropriations Act of 2021, which is known as the CCA. And that act was really intended to clean up some of the things that weren't quite correct in the CARES Act or that needed some further enhancement. And then there are also some new provisions in that, like the new second phase stimulus payment that people are waiting on. So the bottom line is here, there's a tremendous amount of tax law changes. They cover a lot of different areas. And frankly, some of the things that changed, particularly on the business side of the world, are quite complicated and complex. And as you can see, because we had 4 acts in a short period of time, some of this stuff, it took a while for Congress to figure out how to get it right and to re-clarify things that, you know, for instance, weren't done correctly in the original CARES Act, and they had to clean them up at the end of the year. So the other thing that we have is, of course, we're in the middle of a pandemic, and operationally, that's created a problem for all kinds of businesses all across the country, all across the world, really. And the IRS is no exception to that. So we're dealing with an Internal Revenue Service that is extremely backlogged. They have months and months of mail processing that they are behind on. They're dealing with reduced staffing. It's nearly impossible to get a hold of them by telephone and get things resolved and questions answered. And because they are very slow and backlogged in some of their mail processing, that's generating additional problems for taxpayers. So my second point on this screen is one of those issues is we had this summer a whole flood of situations where people paid their tax, wrote checks, either the checks hadn't cleared their bank, or in some cases checks cleared their bank, but the IRS doesn't have the payments posted to their account. And so now the client's receiving an invoice from the IRS saying, hey, you owe a bunch of tax, and the client's coming to us and saying, I paid that tax 3 months ago. And you know, I had a client recently that came to me and they had written a check to the IRS back in July. And when we looked at the back of that check, the IRS had started stamping their endorsement stamps on the back of the check with July dates on them. And that check did not clear my client's bank until December. So, you know, I guess all the rest of us that are in business for ourselves have to get the money to the bank every day and make our deposits. Apparently the IRS doesn't need to do that. So, but the one part of the IRS that's working really well is the invoice generating machine. That thing's working flawlessly, and it's cranking out bills right and left to people for issues in their tax returns and balances that the IRS thinks are owed. So we're very busy trying to respond to some of that. But the problem is, you can't get a hold of people by phone, and you're writing letters to the IRS, and in many cases they're months behind in trying to read those letters and respond. The other problem that we have because of the pandemic, of course, is that the IRS is delayed at getting the new tax forms ready for this year. There are several new forms that they needed to develop and worksheets as a result of the tax law changes. And with their staffing shortages, they're not keeping up. It's been announced that e-filing for this year will not start before February 12th, which is probably 3 weeks behind what it happens in a normal year. So we're starting out behind the 8 ball here, and I suspect that's not going to get better as we go.
Walt?
Yes.
Mary. So
Yeah.
when you say e-filing is postponed until February, I don't think you're saying that we're getting extensions. It means you still need to file your taxes by the normal time.
Correct, and that's what this screen's showing that I just flipped to here. So these are the announced due dates at this point. So individual returns are due at the regular time of April 15th, as they traditionally would have been. You can get a 6-month extension, which moves you out to October 15th if you're not ready to file by then. Now, recall that last year, IRS moved the filing deadline to July 15th for individual returns, and you didn't have to worry about an extension until you got to July 15th. Well, this year they've said that they're going to stick with April 15th. I have a suspicion that that might get moved and changed as we go along here through tax season, but I have no assurance of that. It's a feeling I have that maybe they're going to get into the throes of this and they're going to get enough people complaining because of the delay in starting the filing process, the delay in releasing forms. I think there's going to be pressure on them to move the deadline, but they have, at this point, have said they're going with April 15th. S Corps and partnership returns are due March 15th, which again is the traditional due date. Regular C corporations are due April 15th, and fiduciary returns for trust are due April 15th. And again, the extension dates are here on the screen there. For S Corps and partnerships, it's September 15th is the deadline. And for trust are odd. So you'll notice that on a trust return, even though its original due date is April 15th, its extension due date is September 30th. And that is because when they changed the law a few years ago, they decided that trust needed to get their K-1s delivered to people. So they had a couple of weeks to finish their returns before the October 15th individual extension deadline. And so that's just a wrinkle they put in things. So the other thing that I always like to emphasize, and a lot of taxpayers don't understand this, is even if you need to file an extension and you need more time to get your return done, your tax is due on the original due date of the tax return. So for an individual return, your tax is due on April 15th, even if you're going on extension. So if you need more time to file your return, I encourage people to go on extension. I don't think a lot of people worry that that increases their likelihood that they might get audited or something. I don't think that's true at all. But if you're going to go on extension, you need to get the form, get the extension filed. And that's important because if you don't file an extension on April 15th, and then you file your return in September or October, you're going to be penalized for a late filing penalty. So that extension is buying you an exemption from that late filing penalty. And then you need to plan to make your payment on April 15th. And the reason for that is that there's a separate penalty that's called the failure to pay penalty. And even though you might have your return on extension, if you don't pay your tax until, say, September or October, and you have a balance due, the IRS is going to assess a failure to pay penalty. So there's a burden on the taxpayer to figure out what they think they owe by April 15th, even though they're not ready to file their return, and send a payment that hopefully covers that. So again, just kind of the last step of this whole thing with pandemic tax filing, because of all the things that I previously talked about, we strongly encourage e-filing. So plan to e-file your return. Avoid filing a paper file tax return. And particularly during this pandemic situation and where it's difficult to communicate with the IRS, and we know they've got mail backlogs, e-filing is the way to go. E-filing is safer than paper filing. I am absolutely convinced of that. I have never had a client that we can document a situation of identity being stolen because of e-filing. And I hear a lot of clients come in and say, I don't want to e-file. I'm afraid my identity will be stolen because you're doing this on, across the internet. These are secure links that this stuff's being done through. I don't think that's where the risk is. And those who file, paper file, and send their stuff through the regular post office, I think you've got a lot more risk of something happening there than you do if you e-file. E-filing results in quicker refunds. And if you must paper file, please, please, please send your return certified mail and return receipt requested, because you want proof that your tax return was mailed on time. Every year we go through a situation where we have, you know, a dozen or more tax returns that got filed on time, and the IRS will mark them as late when they were mail filed, you know, sent by regular or by mail. And you've got to have that certified mail receipt to prove you filed it on time. Again, as I said before, e-filing won't start until February 12th. So you got a little bit more time before you need to rush to your accountant to get your tax return filed. And you're going to have to wait a little longer for your refund because of that. The other thing is, make your tax payments electronically as much as you can. Try to avoid sending checks to the IRS. You can make balance due payments, and you can make quarterly estimate payments electronically online. I believe it's secure to do it that way, and you can do that at irs.gov/payments. The only thing I encourage is be very careful when you're making an electronic payment that you're coding it to the correct tax year, because people oftentimes get that wrong and they end up with a payment posted to the wrong year. And then just in general, avoid complications that are going to create you needing to talk to the IRS, because if you do need to, it's going to be a difficult process right now. This means file on time, file accurate and complete returns, and be diligent about avoiding missing income from things like W-2 forms, 1099 forms, and K-1s that will come to you. So try to keep a list of all the ones that you had last year and be expecting them again this year. And if you've got new investments that are going to generate a K-1 or a 1099, be sure that you're looking for those and rounding those up before you finish your return, because the IRS cross-checks this stuff. You file a return with something missing from it, and a year and a half from now, you're going to start getting a string of nasty letters from them saying that you understated your tax. Make your payments when they're due. Be sure they're correctly labeled and coded for the tax year. And the other thing is, when you get ready to prepare your return, whether you're doing it yourself or whether you're taking it to a tax preparer to do it, pay careful attention to your payment history. If you're a person who's making quarterly estimate payments, keep careful record of those payments and the dates you made them. One of the other things that leads to a lot of need to communicate with the IRS is we get people who come in and they say, well, I made 3 estimate payments and they were on these dates, and we file the return and find out that they actually made 4 estimate payments because they get a letter 6 months later from the IRS. Or actually it's the reverse of that. They come in and tell us they made 4 estimate payments, and 6 months later we get a letter from the IRS saying, hey, we only have 3 of those estimate payments. So just careful record keeping, again, is very important. Highlights of tax changes for individuals. So the standard deductions are all indexed and they change every year with some inflation factors. For this year, the standard deduction for a single individual is $12,400. If you're over 65, it's going to be $14,050. For married filing jointly, the standard deduction is $24,800. If both spouses are over 65, it's $27,400. And head of household is $18,650, and for an over 65 taxpayer, it's $20,300. IRA deductions for this year. If you're under age 50, the limit is $60,000 for a regular IRA, or I'm sorry, $6,000 for a regular IRA. That's unchanged from last year's tax law. If you're over age 50, it's $7,000. If you're a person who has a simple IRA plan through your work and you're able to do deferrals, if you're under 50, this for 2020, you could defer $13,500 into your simple IRA, which was a $500 increase from the prior year. For people over age 50, they get to go to $16,500. And then going down to 401k plans, same thing. those are typically through your employer, and you're deferring from your paycheck into those with your voluntary contributions. If you're under age 50 for 20, the limitation was $19,500. And for somebody who was over age 50, it went up to $26,000.
Walt, this is Mary.
Yes. Yeah.
You have a couple of minutes left, and I know there is one question for you. Somebody had a question about stimulus checks. So
okay, let's jump to that. So, yeah, I knew I wasn't going to get through all of this. This is
we're being recorded, so people can go back and watch this video. So don't jump through. Go back to where you last were, and at least let the screen stay there for a second, so it's
okay.
recording.
Okay.
You just don't need to read through.
So these are the changes for HSA contributions. The annual gift tax exclusion's unchanged, and the estate tax exclusion is $11,580,000, and that's going to sunset in 2026 and roll back to a lower number. A lot of people are getting unemployment checks this year, and some people are going to be surprised when they find out that's taxable or didn't expect that, and a lot of people don't have federal withholding on it. Educators get to take an extra deduction this year for PPP equipment and disinfectant supplies for their classrooms. There's a new charitable contribution deduction this year. It's $300 per person. If you're a person doing standard deduction, you get to take a charitable contribution deduction above the line. That's new for this year. And for a married couple, it's $600. And that was in the year-end tax law, and that's retroactive to January 1 of 20. The medical deduction threshold is now at 7.5% of AGI, and it's going to stay there for the next several years. Mortgage insurance premiums are once again deductible on your mortgage insurance, subject to some income limits. And for some people, they may be able to amend returns for 18 and 19 and get money back. The other thing, cash contribution. Sorry.
I'm sorry to interrupt. Let's just leave the screen here for a sec.
Okay.
So people can read it in the video, and then just move to the next screen. So highlights of changes for individuals, and then the screen, if that's possible. Okay,
the recovery rebate credits. This is the stimulus money. So I'm gonna let this sit here, but I'm just gonna talk about this for a second. The stimulus money, a lot of people got checks in the first stimulus at the beginning of the year. Now it's been announced that there's going to be another stimulus payment. I think some people have already started to get them, and they're going to be happening in 2021 here in January also. This whole stimulus credit thing is actually a credit on your 2020 tax return. So whether or not you got a payment in the first payment or the second one is almost irrelevant, because what's going to happen is on your 2020 tax return, the amount of credit that you're eligible for is going to be calculated based on your 2020 income. If you already got paid the stimulus money in the 2 checks, you get to keep it. If you didn't get your stimulus checks and you're owed stimulus checks based on the calculation that's in the 2020 return, you're going to get that credit on your 2020 return. So people early in the year who were panicked because they didn't get a stimulus payment, they still may get it when they file their 2020 tax return. It will be part of their tax calculation.
So to answer the question for Patty, she got her first stimulus check, back in the spring of 2020.
Right.
Through a direct deposit.
Right.
When the stimulus checks in the second round went out in December, and they were valid as of January 4th, she did not get that check. So is there someplace she should be looking online to see where the check is? Or at this point, if she didn't get another electronic deposit, it would wind up being a tax credit?
If she's eligible to have gotten that second payment, she will get it as a tax credit on her 2020 tax return. Now, she may not be eligible for that second payment. It's very odd the way the calculation works on the phase out of these stimuluses. And there are a certain set of circumstances where a person would have gotten a stimulus check on the first payment and they're not going to get one on the second payment. And it has to do with the way the income phase out works. So she's just most likely at this point, I would recommend that someone not worry about it. Get your 2020 tax return done and figure it out on your tax return, because if you're owed additional money, you're going to get it on your 2020 return. And the other thing is, it's going to be very important if you're going to a tax preparer to have your return done, you need to have the amounts that you got in those payments and provide those to them. And the IRS actually sent out a form to taxpayers. I think it's a 1444 or something like that is the number of the form. That's a notice that they sent out that tells you how much stimulus you were getting per their calculations. But again, their calculations were done based on your 2018 or your 2019 adjusted gross income. And your actual credit is going to be based on your 2020 gross income, adjusted gross income. And for many people, their 2020 adjusted gross income is less than what they made in 2018 or 2019. And that means that there are people out there who got no stimulus payments, but when they file their 2020 tax return, they're going to find out that they are getting some stimulus money. Last thing I want to point out is just everybody knows about on retirement accounts, the RMD minimum age has changed from 70 and a half to 72. There's a lot of information available online about that. They changed the stretch IRA rule. So people who are, if your spouse dies and you inherit their IRA, you can still spread the distributions over your lifetime. But if you pass away and one of your kids inherits your IRA, they're going to have to take that money out over a 10-year period. The rules changed. The other thing that's new for this year is you can now make contributions to an IRA after you have reached your RMD date. So after you've started your required minimum distributions, you can still make contributions to an IRA now, so long as you are still working and have earned income. Under the old law, you had to stop making contributions when you turned 70 and a half. That got changed. And then on business returns, I'm just going to hit this 2 minutes here because I know we're out of time. PPP loans are now not taxable income. If you're a person who got a PPP and you get forgiveness, you don't have to pay tax on that. If you got an EIDL loan and you got one of the grants that came with the EIDL loan, so you got a $10,000 grant up front, that is not taxable income. And that $10,000 EIDL loan grant that you got also does not reduce your PPP forgiveness. And the other thing about PPP that's important for everybody right now is there's a new Form 3508S that's coming out from the SBA. It was supposed to be released this week, and I haven't looked in the last 2 days to see if it's out yet. But for those who got a PPP loan of under $150,000, you are going to be able to sign a one-page form to request your forgiveness, and you're not going to have to supply all of the detailed calculations and schedules about how you spent your money and payroll. And then the last thing that I just want to mention is there are 2 other programs that give money to businesses to help with the pandemic. One is the paid sick leave credit. If you have an employee who's out of work because of COVID and you pay them sick leave pay, you may qualify for some credit on your federal unemployment or on your employment taxes, your Form 941. And for an individual employee, you could pay up to $10,000 of sick pay and get that reimbursed at a high percentage by the government. There is also a thing called the employee retention credit. And not many people know about this or paid much attention to it, because under the original law, they said that if you got a PPP loan, you couldn't use the employee retention credit. That changed at the end of the year, and they changed the law and said, now you can do both. And that is retroactive for 2020. So what that means is if you got a PPP loan early in the year, you spent your PPP money to pay your employees, and you got finished with that spend period, and then say you had 2 more quarters of operations and you were restricted, you were partially closed because your place of business couldn't have people in it, you can use the employee retention credit and you can file for refunds on your, or credits against your employment taxes and help subsidize the cost of your employees. It's worth a lot of money. I had a restaurant client that we filed one of these for fourth quarter, and they got a $47,000 credit this year. And that retention credit is going to run for another 2 quarters here in 2021. So it's really important for a lot of businesses right now that are still operating with deep sales declines, or they're under some kind of restriction that they can't be open for business. That's it. Sorry I ran over.
That's a lot of information. And if you stop the screen share, we'll jump right into Matt. If folks have questions for Walt, what I would suggest at this point is that you put them in the chat bar or email them to me, and I will get the answers from Walt and get them back to all of you. How's that?
Perfect. Thank you.
Thank you, Walt. Matt, the floor is yours.
Good morning, everybody. Good afternoon, everybody. So I have a quick question for you, or rather a question, and the question is this: has anyone seen the movie Maverick from the 1990s? So you've got Jodie Foster, you have Mel Gibson. It's a Western poker movie. What ends up happening, there's one scene in the movie where Jodie Foster, dressed in her southern garb, walks into the casino, and all the guys around, they're all paying attention to her because she's the only girl in the room. And there's the guy playing the three card shuffle, right? So people are betting, they're trying to find the queen, and the queen keeps disappearing as he deals, because he's dealing according to his own rules. And so as he's dealing all these cards, she sits down and feigns to be, very naive. She's very sharp. She feigns to be very naive. And she sits down and she makes a couple of wagers. She pays him several dollars and she loses the money because she just can't find the queen as he's moving all the cards around. And then she puts down a large amount of money and says, I know I've got it this time. And so his eyes are shining. He's moving those cards around really fast. All you do is find the queen, find the queen. And then he stops and she hesitates for a second and she slams her hand down on the middle card. And she says in her most genteel Southern voice, she says, now, Mr. Dealer, he says, I know that this is the queen. And if you show everyone those other 2 cards, that will prove that I got it right. And in essence, she hustled the hustler. So he, of course, pulls up those 2 cards, which are not the queen, because none of them are the queen. And she gets paid back a large portion. Most of it is actually her own money. What does this have to do with financial planning? You have to remember that Uncle Sam is the dealer and you are Jodie Foster, and it is your job to play by the rules. You just have to make sure that you play by the rules in such a way that you get to keep the majority of your own money. So, real life example. In magic, a lot has to do with misdirection. In money, everything has to do with intention. So, case study, a client comes into my office and he says, virtually now because it's COVID, he comes into my office and he says, hey, Matt, he says, I'm a realtor. He's a realtor. His wife works in the hospital. They made an extraordinary amount more than what they made last year because he's done so well with his realtor practice. And he says, hey, I realize I should have told you this back in October, but I had a banner year. What am I supposed to do to make sure I don't get killed by taxes? And I'm there on the phone with them. I'm like, well, you should have told me in October instead of January for last year, but let's see what we have to do. So I'll tell you the solution of what we came up with, but here's the thing that you have to remember. Has anyone ever heard the term DINK, D-I-N-K? It means dual income, no kids. So this is the situation that they're in, right? So now what happens is with this, you have to remember that they make a lot of money. They make income, so income is not the obstacle. They also are very good savers. They have no debt, no car loans, no student loans, no credit cards, so they save a lot of money. So also the saving or the money management is not an issue. Those are two different conversations. This conversation is specifically focused on how they can make their money repositioned so that they can keep more of their own dollars by being more efficient and more effective with how they're positioning their money. So case in point, what we do is we set up a certain type of account because all we want to do is move money from one side of their desk to the other side of the desk so they can keep more of their own dollars from one type of account to another type of account. We open up a SEP IRA for them, which the IRS allows you to contribute this year for last year, and therefore he is able to contribute an amount up to 25% of the money that he made for his W-2 last year. He's able to move all that money from his business checking account to his new business investment account, and none of that money has to be taxed. That's for last year. Then we set up a solo 401k for him this year. We roll the SEP immediately into the solo 401k. He can now, like Walt said, save $19,500, all tax sheltered for this year, plus an additional 25% of his income. The shell game, right? A lot of info, you don't have to remember it, just know that moving all the pieces around and making sure that you know exactly where those pieces are because you're following the rules gives you the advantage so the IRS gives you back more of your own money. There are 50 pages in the tax code that say why we have to pay taxes. And we should pay taxes. Paying taxes is really important. There are 500 pages in the tax code talking about circumstances and situations where we don't have to pay taxes. So it is just an example of playing by the rules. A good friend of mine, his name is Dan. He loves board games, especially strategy board games. And so whenever you play with him, you have to be very careful because the way Dan wins, and he wins almost every time, is he studies the rule book. And so you'll go and you'll be making this move deep in the strategy and you'll move your piece here and then he'll stop you and be like, oh, I don't think here, let me double check. Oh yeah, page 17 of the rule book. See, you can't move like that. And so you have to take your piece back and then he can move right in and now suddenly he wins the game. And the reason that he wins is because he knows the rules. Taxes and investing are the same way. The people who win are the people who know the rules. So suffice it to say, the way we've set things up for them this year, he has a 401k, she has a 401k. Together, they can contribute $19,500. They can tax shelter $39,000 per year, plus 25% of his income as the employer match. And now suddenly they're able to shelter an extraordinary amount of money. And all this is money that they had been paying in taxes to Uncle Sam that they now get to keep. So then the question comes, well, what if someone isn't working anymore? What if someone's already retired? Now what happens is this: how do you position assets in such a way that you as a retired person, not putting more money in, get to keep more of your own dollars? Walt is my CPA. I love the work that he does. Tony Hinson is my estate planner. I also love the work that he does. Today, I'm like in speaker heaven because I'm sandwiched between two guys that I really respect and I love the work that they do. That is really, really fun for me. The cool part about making sure that you're positioning things in accordance with how they're going to be most effective means you have the most control over those dollars. So here's what I mean by that. As Walt was talking about tax brackets, now tax brackets have changed and deductions have changed. That is such an important thing to grab as a concept. It is so important to work with Walt or your CPA to make sure that you know where you fit in that tax bracket, especially as a retired person. Because the IRS allows a person to make this much money and still only be taxed at 12%. If they make more than that, they're taxed at 22%, right? It's a huge difference. So as long as you make only this amount of money, say that you made this amount right here. Let me do this so the camera works. You can make this amount still be taxed at 12%. Say you make this amount, that leaves this part here. This part here is what we call potential. It is very important that it is realized potential instead of unrealized potential, because what you can do with these dollars is you can move them from one side of your desk to the other, still only be taxed at 12%, and position those assets in such a way that they have the ability to do a lot more things for you in the future. So how does that work in real life example? Say you had all your IRAs, your pension money, your Social Security all comes in, that's part of your equation. Well, now say that little bit that you have in the difference where you're still being the 12% tax bracket, say you move that out of an IRA and into a Roth. You pay the taxes on that voluntarily, and then you put it in a different type of account that now gives you the ability to have that money grow tax-free and come out tax-free. All the profits on that account moving forward, you will never have to pay taxes on again. Why is that important? Because now that you've paid 12% on that money, if you didn't ever use it and you gave it as your kids to an inheritance, well, they would also not have to pay taxes on that money when they got it as an inheritance. Whereas an IRA, as Tony would tell you, they have to pay a lot of taxes on that money, and they have to take it out in a certain amount of time. So they're forced to pay taxes on that money quickly. But if it's now in the Roth, not only do you have more freedom to give it as an inheritance, but you also can now choose when you want to pay taxes on, or when you want to utilize that money in combination with the other money that you have, to make sure that you're balancing your taxable income with your pre-tax income or your post-tax income. That gives you choices. And what happens if you had that conversation not when you were 60 or 70 or 80, but you had that conversation when you were 40 or 50? Now you can start to prepare in advance to make sure that that bucket is big enough that you can determine how much taxable income you're going to have in retirement, which then means you pay less in taxes over time, which means you get to keep more of your own dollars. Not necessarily the most clear financial concepts, but these are the games that we play, the moves that we make to play by the rules to make sure that things happen so clients keep more of their own dollars. The final point that I'll make is this, because it's just the tip of the iceberg, is that being a fiduciary means that we legally, everything we have to do must be in your best interest. There's a part of that that's the financial planning. So my job is the financial planning, to make sure we're setting things up, to make sure people are on track to hit their goals and they're able to keep the majority of their own money as efficiently and as effectively as possible. Mark Pearson in our office is our money manager. He's the one who does all the buying and the selling for client portfolios. And then we have our in-house research team. So Chuck and Connie and Arindam, they're the people who are making sure that all the K1 for the companies that we own are read, making sure all the economic indicators are in place. So this is the team that works together for our clients. It's so important to not only have the investment strategy, but also the financial planning together. And the reason is you could have the best financial plan possible, but if you don't have confidence in your investments to make sure that they're positioned in a way that can take advantage of the ups and downs, you won't necessarily stick to that financial plan. In addition to that, you could have the best investment strategy possible, but if you don't have things positioned in such a way that you keep your tax money, you could pay through the nose for taxes for some successful investments, and therefore it becomes kind of a self-defeating process. Having those two things working together is what true successful investing means, to make sure that clients get to keep more of their own money. A lot more to it than that. I have a big conclusion that's very profound, even poetic, but in the interest of time, I want to make sure that we give everybody a chance to talk and still get questions answered as well. So in summary, what we've got then is that you have the ability, the most important thing is to make sure that you have the ability to keep the majority of your own money. It's important to make sure that you're playing by the rules of the game. Well, always keeps me on track, because I'll come to him and be like, hey, can I do this and this and this? And he'll be like, no, but you can do this. Okay, that sounds good. He laughs because he knows it's true. And so we make sure we play by the rules, right? But we make sure we do it in such a way that gives the game the opportunity for the player, for you, to make sure that you have the best opportunity for success. Must make sure that that's happening also remember that retirement is not a hit 65 and now you're done. Retirement is in your 60s and your 70s and your 80s and your 90s. That can be a 40-year chapter in life. So making sure that you're planning while in retirement is also incredibly important. And then making sure the financial planning and the investment strategy are merged together also is absolutely integral. So ideally, those things give you some ideas about what the most important thing is to make sure that you're in control of your dollars. So thank you, guys.
Thank you, Matt. That was awesome. And I think what we'll do is we're going to bring Tony on right now, and we're probably going to go a little bit past 12:30 because this information is really important. And I say, if you have any questions for Matt, let's hold those till Tony's done, and then you can ask all your general questions. The floor is yours, Tony.
Okay, and I'll ask the same question Walt did. Is the presentation showing okay for everybody? Excellent. All right, and I want to mirror what Matt said about it is a pleasure to be here with these two gentlemen. They are my go-tos with questions. Walt and I end up working on estates with the income and the estate tax issues, and Walt's always great to work with, and we coordinate really well. It's nice to know that there's a CPA around who truly gets the quirks of working with an estate. And Matt is my investment advisor, so I'm wondering why he's here and not out making money. So no, just kidding. It's great to present with both these gentlemen. They're fantastic. So a quick background, just to let you know, takeaways here. I actually worked for the IRS for 9 years. It's not a bad place to work. There are good people there, trust me. However, I wanted to come to the good side of the force. And I do note that I was a Navy JAG for 25 years. So I often kind of say those kind of balance themselves out in the whole yin yang thing. So maybe I'm still a good person. I don't know. I guess we'll find out. So we're going to go through some of the legal and estate planning issues with income tax planning for the next couple of years, particularly 2021, and look back on 2020 a little bit as well. So we're going to review IRA issues. We're going to look at the Secure Act because it continues to have repercussions. A quick look at estate and gift tax issues, and finally, just a mention of the Washington Long-Term Care Trust Act, which is lurking out there and is going to come springing to life in a little under 1 year. So first, there are very few cartoons about IRAs. This is pretty much the only one I was able to find, so I figured I would include it in there. So your IRA's got enough bus fare to get you there. It's a good thing. Work with Matt, work with Walt, get them funded. RMDs are back on, as Walt mentioned, for 2021. It's unknown. The CARES Act suspended those. The action that was taken on the first round of stimulus did not readdress that. There's been some interesting chatter on the estate planning sides as whether or not Biden is going to include another holiday for 2021 in the stimulus package as it gets rolled out. So as with so much with tax law this year, stand by. We got a 51-50 Senate majority in favor of the Democrats. We've got a House that's got a very narrow Democratic majority. So it's going to be interesting from a tax point of view, both income and estate. I do say that if there is another holiday, that an awesome opportunity, and this will play into both long-term care, Medicaid, and inheritance planning, is consider taking what would have been the RMD for 2021 and rolling that and doing a Roth conversion on that amount. It's a net zero of what you would have been if you'd had taken the RMD, and it gives you a shot at that Roth conversion. Roth conversions, love them from an estate planning point of view, as long as they make sense. And that's when you call Walt, and that's when you call Matt, because I am not a financial advisor. I do know that when it comes time for Medicaid planning, I'd much rather have someone be forced to liquidate a Roth IRA and gift it over to one spouse if you're doing intra-spouse planning, than have to liquidate a traditional IRA, because that is an income tax disaster. So it's a good idea for a multiple number of reasons to be thinking about Roth conversions. Can also lessen the impact of the Secure Act when you pass that IRA on to your children. If you've already picked up the income tax years before, it's an indirect way to make a gift to your kids in a lot of ways. 2020 IRA contributions must be completed by April 15th. No change there as far as I know. QCDs, qualified charitable distribution. I'm not going to go into a lot of depth here. This is a great way if you don't need your RMD and you're going to have to take your RMD, and your RMD would be much more than the $300 or $600 charitable deduction you might have to take, and you're going to be limited to the standard deduction anyway. The qualified charitable deduction makes sure that that RMD never touches your 1040, and it goes directly to the charity, doesn't knock you out of qualification for many tests that rely upon AGI. It's just a great way to get the money where you want it to go and get the full benefit of that. Now we're going to talk about the Secure Act, and I'm an Iron Man fan, so I always put this in here if I can. It changed everything last year when it comes to estate planning. The good news, as Walt mentioned, mandatory age for RMDs increased to 72, so it gives you another year and a half before what you would have before in order to let that grow inside the IRA. You can continue to contribute earned income to an IRA after 70 and a half, and spousal rollovers of IRAs received from the deceased spouses, there was no change to that. You still, if you are the surviving spouse and you receive an IRA from your predeceased spouse, you can roll that into your own IRA. It's as if your predeceased spouse never existed for purposes of that IRA. Your own age controls RMDs, the whole bit, and the inheritance rules take effect as if that was your IRA all along. The not so good news, no more stretch IRAs in most circumstances. Non-spousal beneficiaries must, in almost all cases, take the money out of the IRA within 10 years of the decedent's death. If it's a Roth, that's not as bad because it's not all income, but you're still losing that opportunity for tax-free growth inside the IRA. So that's a bummer. And if it's a traditional IRA, then you're going to have that income tax hit much more quickly. In the old days, meaning 2019, your child could have used their life expectancy to slowly take the money out of the IRA. And unfortunately, that is not the case. There was some push in Congress to modify the Secure Act shortly after it was passed. The AARP and several other lobbying groups were in favor of that. However, then, COVID hit, and that was put on the back burner. So the thought amongst estate planners now is that we're probably stuck with the Secure Act, at least for the foreseeable future. The good news on the lack of stretch is that, particularly with chronically ill and disabled individuals, not quite the same definition as Social Security, but my assumption is this wouldn't be a big audit area for the IRS anyway. If you want to set up a special needs trust for someone who is disabled and receiving Social Security and you're looking towards Medicaid qualification, you can still use their life expectancy to draw the money out of the IRA if it's put into a specific type of trust. So that can be helpful. Also, spouses are an exception. And you're wondering, why in the world would you ever want to take it out according to your life expectancy and not roll it over? It's for some credit planning if we've got estate tax issues. We believe that's still an option. However, the law was rather poorly drafted, and so there's still some questions there. And no indication of any amendments for 2021, unfortunately. Estate and gift tax issues.
Tony?
Yes, ma'am.
During the presentation, can you also explain the acronym? So RMD.
Oh, I'm sorry. Yes.
Required minimum distribution.
So an RMD is a required minimum distribution. It is the amount that the IRS requires you to withdraw from an IRA each year. Just a funny story. In the code, it's called a minimum required distribution, an MRD. My understanding was early on, one of the larger brokerage houses put out an article and screwed it up, and that acronym stuck. And so we actually flipped the acronym in the code. But it's the amount that you have to take, regardless of your status, if you have to take out of an IRA for that year. Failure to take an RMD means that you make an appointment with Walt and he gives you some bad news about penalties and the like. So you always want to get those RMDs out of there. So, and if I use acronyms, please interrupt me. That's part of my Navy side, and I don't always specify those, and I apologize. So for 2021, the Washington estate tax exemption is stuck at $2,193,000. It is a fascinating reason why it's stuck. We'll just say that the 2017 Tax Act wasn't the most artfully crafted thing in the world. And unfortunately, the way it works with the revised Code of Washington means that we're stuck at $2,193,000. Whether or not what changes are made, that could result in an increase. That's a lot. It includes life insurance, it includes your IRAs, it includes your house, so folks can get closer to that amount than they think before they know it. The federal combined gift and estate tax, there's no gift tax in Washington. So if you give something away, as long as the gift is complete before you pass, it is not, in most cases, part of your taxable estate. We're looking at an $11.7 million federal exemption right now. What's that going to be in June? I have no idea. That's one of the areas where the Biden administration is interested in lowering that amount. Their platform, I believe, called for a $3.5 million exemption, still really big, but much smaller, and $1 million gift. Whether or not they can get that through, whether they just stay at maybe a $5 million, remains to be seen. As I said, it's going to be a fascinating year tax-wise. Annual gift exclusion stays at $15,000. So I'm going to guess it's probably going to nudge up to 16 next year, but it's always kind of an exciting time in October when we get the news from the IRS of what those are going to be for the next year. As I said, there's much uncertainty on the federal side. We could see a rate increase. We could see a credit decrease. Could see a compromise. There are some conservative Democrats and liberal Republicans, and you never know how these folks are going to vote. So it's going to be an interesting year. Gift tax returns due April 15th. One little known fact is when you extend your income tax return, you also automatically extend your gift tax return. So if you made gifts over $15,000 a year per person in 2020, that return is due April 15th. And then estate tax returns are generally due 9 months after the date of death. However, there's an automatic 6-month exemption. And almost every single time, those returns are going to be filed 15 months after death. As Walt mentioned with income tax, if you do owe estate tax, you have to pay with that extension. Otherwise, you could be looking at some penalties. And then finally, I wanted to cover very quickly the Washington Long-Term Care Trust Act. This passed very quietly. This is an attempt by the state of Washington to supplement the amount that they already spend on long-term care through their administration of Medicaid. A little known fact about Medicaid, it's a federal program that's administered by the states, and there is some state funding in there as well. So this is probably a first try, a first attempt. We're looking at a payroll tax deduction starting in 2022 of 0.58% of W-2 earnings. And that is going to go towards a trust fund that will be invested that will provide after 2025 up to $36,500 per resident, as long as you paid in for, I believe it's 5 years prior to your need for long-term care for your long-term care. If you've been familiar with long-term care, you will know that $36,500 doesn't go very far. So again, this is probably a first attempt. What's going to happen in the future? Unknown. There will be opt-outs if you have long-term care insurance. Right now, the opportunity to opt out begins this September or October, and it will go through 2022. And then as people come into the workforce, they'll have opt-outs as well. A lot of this is still working, and there's been talk that the legislature is going to revisit this a little bit this year due to some pushback received in the tax and the voter initiatives last year, and may have to rehab it a bit there too. One big question everybody had on their ballot, whether or not the state of Washington would be allowed to invest these trust funds in the stock market and could take other, and that was part of the planning for this. And no one knew what that voter initiative was all about, or it was a constitutional amendment, but it failed by 300,000 or 400,000 votes. And so that's caused some rethinking of how this is actually going to work and be financially solvent. But stand by, there will be a payroll deduction most likely coming in 2022 as Washington and other states try to solve the long-term care conundrum.
Tony, go back to your last slide, please. We've got a couple of questions. So number one, is the LTC trust, which I'm assuming stands for Long-Term Care Trust, only for people that are actually working, not for retirees?
As I understand it, the payroll tax, 0.58%, is going to be on W-2 earnings, earned income. So the upside of that is it will not be taxed necessarily on passive income. The downside is I don't know what the retroactive qualification rules. I still need to do some digging on this. And from my understanding as well, those are being looked at. So if someone is already retired, you know, what coverage is going to be available, if any, for those folks. So it's, again, it's a first stab at trying to address this problem. And as with all first stabs, it's not going to be necessarily perfect.
So Tony, still on this screen then, if I'm still working, my W-2 earnings, I'm just going to use a number that's easy. I have a calculator in front of me. If my W-2 earnings are $30,000, I would times that by 0.58%. And that means only $174 is being put towards this LTC insurance.
I
That doesn't sound right.
don't have a calculator,
Okay.
but it's 0.58% of W-2 earnings.
Okay.
So if you make $100, that means that 1/2 of a penny is going towards this trust fund. Again, this is going to be collected in the aggregate, and it's going to be collected going forward. So if you're 30 years old, making 30 grand a year, you're going to start paying in, and you will be paying in for this as you earn income in Washington. And whether or not this is going to be viable long-term, that's going to be interesting as well. The GET program faced significant problems. The Guaranteed Education Tuition Program in Washington, Washington's 529, faced some actuarial problems for a number of years because things weren't anticipated. So I would anticipate some tweaks to this act as we go forward to make it financially sound.
And then just to clarify on the other question. So if somebody is retired, let's say they're 70 years old, and they're no longer getting income from a job, but they're getting income from Social Security. That's their income.
These are W-2 earnings, just to jump ahead.
So a Social Security check is not a W-2 earning, you're saying?
Not going to be a W-2 earnings. It's not an earned income. It's earned. You know, that's not a qualitative term. That's a technical term. It's not going to be earned income. And as I understand it, this act is only going to affect earned income.
Thank you.
Absolutely. Okay, let me click back on that. All right, are there any other questions for, and I'll take this down, so there probably should be a general Q&A at this point. So let me stop sharing. There we go.
Let's open up the floor for everybody for questions. So if somebody has a question, please unmute yourself or raise your hand and I'll call on you because I could see all of you that have their picture going. Let's see. I don't have any new questions in the chat. Terry, Steve and Patty, Tammy, Kathy, do any of you have questions for Walt, Matt, or Tony? So this was our first compass points, and I'm going to give my feedback. Number one, I thought the presenters were exceptional. You are definitely wise and expert in your fields of which you practice, and I thank you from the bottom of my heart for participating in this. I do think, though, that limiting this to 1 hour means we probably should have 2 presenters when we have so much information to share so that nobody feels like they're being rushed and they're not able to get all their information to everybody. Because we are recording this, though, that does give everybody the opportunity to watch the recording again and again. And I will be sending that link to everybody along with the 3 presenters' contact info, so you can, of course, reach out to them directly. Anybody? Thanks to all 3 presenters. Really appreciate the screen notes. Everybody did a great job. It's been very beneficial, great information. I'm reading new comments off the chat bar. So at this point, if no one has questions, I'm going to stop the recording.